Hello, my name is Adriene Bailey. I'm a partner at Oliver Wyman and in charge of the Americas Region's rail practice area. I spent a lot of my time consulting with railroads, with intermodal companies, with terminal operators, chassis companies, pretty much any part of the ecosystem that involves the railroads and intermodal conveyance. Excited to be here today. Want to say thank you to Bruce Patty as well as to Informs for hosting this great conference and inviting me and Oliver Wyman to share some thoughts, ideas, and research that we've been involved with in the past year or so. So I realize that this will be a bit of a one-way conversation, but I'm hoping that many of you will be able to stay around for the question and answer period that will follow, and that we can have some good and engaging kinds of conversations at that point. I'm just going to share my screen and take us to a bit of research that Oliver Wyman engaged in the 2020 timeframe, and has actually, frankly, become almost more relevant now than it was at the time. Our approach was to understand where the railroads need to go in order to obtain at least their fair share of the market and to grow profitably into the future after a period of time, as we all know, of precision scheduled railroading and a lot of cost cutting and cost containment and streamlining of their operations. So the growth imperative and railroads' pursuit of freight share is something that we think is a very important aspect of the railroad industry for its long-term vibrancy and health, as well as being a very important aspect of our economy and our society as we try to move ourselves into a much reduced set of carbon footprints across all of the different kinds of activities. And certainly the movement of freight is an important one for us to consider. So I'm going to share with you here in the next few minutes just the results of our research and some of the things we found. But first I want to level set on where is market share for the railroads now, and where is it seem to be going if we look back a bit into history. There really is growth and strength in some of the sectors that the railroads are involved in, but we can understand and see from this data, which I'll walk you through in a little bit of detail because it's not the easiest slide to interpret on the fly. The biggest segment of the freight market, which is freight that has a choice between truck and rail, is the one that's growing the fastest and the one that the railroads are having the most trouble holding on to their market share. So let's just take a minute and walk through this slide so we can understand what the numbers are and kind of Oliver Wyman's perspective on what the numbers are telling us about rail freight market share. So in 2018, you can see the ton miles in trillions that encompass the entire market. And we were looking at the freight analysis framework data and the Bureau of Transportation Statistics for all of this analysis. It's all in the public domain. But what we did was we separated the commodities that are moved within that freight portfolio that moves across the North American market and into really 4 separate categories. And we'll go from the bottom up. Coal, we all know what coal is. We all know that coal ultimately is going away. Not sure about the time frame, but it's a part of the market that's been a very important part for the railroads over time, and it's a part of the market that is not going to be with us forever. Then what we have next is the truck-centric part of the market, which is things that will very rarely, if never, find their way into a rail car. So we might think about telephones, semiconductor chips, things that are very, very high value or very, very time sensitive, and they will not easily be migrated into a rail product at any point in time. And if we jump up to the top of this bar chart, we see what we call rail-centric, things that are bulky, things that are low value, things that do not have a significant transit speed element related to them, things that the railroads do extremely well. And what you see in the middle is pretty much everything else. And we've called that flexible freight, and it's freight with a choice. This is the freight that can move in a truck or move on the rail, whether that's an intermodal container or whether it's a rail car conveyance. It is freight where the shipper is able to move it in either truck or rail. And what we can see is that that is by far the largest segment of freight that's moving around in our economy today. The next column over just shows you where the growth in the market is. So we see the coal very predictably declining in its share of the total, or its growth percentage. It's declining by 4.8% per year. The truck-centric and the rail-centric freight is growing modestly, but the flexible freight in our economy is where the growth is coming from. And then the third column over tells us where is the railroad network today playing a significant role in terms of its market share of that freight. And understandably, we see a very high share in coal. We see a nice share in the rail-centric commodity area. We see a smaller share in truck-centric, but somewhat surprisingly, we see only 22% share in the flexible freight category. And if we move to that fourth column, we see that while rail is growing its share at a small annual rate of 0.3%, in the rail-centric commodities, it is losing share in the flexible freight commodities. So once again, just to summarize where we came to in this bit of research on the freight market data, that this group of commodities that have a choice between truck and rail, the flexible freight in our system is the largest and the fastest growing sector of the freight economy. And it's the place where the railroads really need to focus if they are going to grow and take back market share. So let's just talk a little bit about where market share is and has been. This is a discussion that Oliver Wyman has been having with the industry for quite a few years now. And what we have observed is that the railroads are on a path that looks like a share loss over time, as well as the trucks being predicted to grow share in the out years as we head into this next decade. Our view is that a simple strategy of holding share is going to create a great deal of value in the railroad industry. And the real truth of the matter is that commodities that are in the flexible freight category tend to have a higher average revenue per ton than the rail-centric commodities. So not only is it a share play, a volume play, it's also a margin play, because these are commodities that tend to pay more than the bulk commodities that are very rail-centric, where the railroad is clearly gaining share and holding a fairly large percentage of the share of the market already. So it's worthwhile for railroads to understand what it's going to take in order to recapture that, at least hold share, or even retake some of the share that they've lost to the trucks over the last years. So Oliver Wyman spent some time in late 2020 investing in research directly with the customer base. So we spoke with very senior supply chain executives in 7 different industries: automotive, food, chemicals, metals, retail, in the 3PL, 4PL category, because we understand and know that it's a growing area where shippers are turning over the management of their freight to those providers, as well as the oil and gas industry. There were a lot of freight covered in terms of the control of the freight. 40% of the interviewees have over $100 billion in spend, in revenue, and their transportation spend exceeds $40 billion. There were 24 folks that we spoke with across those 7 industries, and really we were narrowing in on what it is that is going to be required in order for railroads to hold and regain share in the freight markets, based on what shippers are experiencing, what shippers see as the next trends and evolution of the supply chain. So we focused in on supply chain trends, transit reliability, and the customer experience. The bottom line was quite clear and very, very, very consistent across all of these senior executives that we spoke to. 100% of the people we spoke to prefer truck to rail on all attributes of customer experience. And we asked people, what is the most important elements of the customer experience? It was fairly overwhelmingly concentrated in 3 things. And you see at the bottom half of this slide, it's around equipment and capacity, on-time performance, and let's just note that that does not say fast, that says on time, and shipment visibility. And in all cases, these being the 3 most important attributes, in all cases, truck was substantially better in terms of its performance against rail. So in those conversations and based on our analysis, we really came to the conclusion that there are 3 very, very important things that the railroads need to do in order to regain their position and share in that freight market. The first is to serve the new supply chain. And there is no doubt that supply chains have become more sophisticated, more geographically diversified, and they are valuing a different set of levers than if you would spend time with shippers 10 years ago or 15 years ago. So where transit time was a consideration, and perhaps there was an inventory carrying cost associated with that, shippers are now including a much wider range of variables within their choice models and their selection criteria for which mode are they going to choose, and also which carrier within that mode are they going to choose. So we see reliability and evaluation of reliability coming into play, along with things like exception handling, as well as information timeliness and accuracy. These are the kinds of factors that are being built now into the choice models of more sophisticated shippers, and we think over time this will migrate into more and more of the supply chain community, that the choice models will become much more tuned to what the supply chain is trying to deliver as part of that shipper customer ecosystem, versus simply a very straight up, here's the price, and maybe I've gotten sophisticated enough to put a little bit of inventory carrying cost into that consideration based on the difference between the static transit times. But what we know is the static transit time is one thing, the variation around that standard transit time is another, and that can vary widely between carriers and certainly between modes. So this new supply chain that has to be more resilient, it has to be more predictable and stable, and it has to be more flexible. These are the kinds of things that have not been in the railroad sweet spot in the past and need to be considered as we go forward in order for them to remain relevant within the new supply chain. One of the sort of most telling examples we had from several of the customers is they are repurposing parts of their plants or facilities where they had a direct rail served dock. They are repurposing those areas, and when they're building new plants, not building a direct serve for rail. And the comment was, well, we have a higher and better use for that space. So railroads have to be very, very careful about how they are approaching the product delivery and the customer experience so that they are not dealt out of the deck before the game even begins. And this is a big area of concern in terms of how railroads are going to continue to maintain and grow their share. The second is probably really, really obvious to everybody who does any business at all with railroads. The variability in rail transit times is quite significant. In fact, if you have a 4, 5, 6 day transit time, the variability around that transit target can be equal to or sometimes greater than the actual average transit time itself. Some of the railroads have been very public about their, carload performance against trip plans, and they tend to struggle to get up above the 70% mark. And we know in the trucking community, door-to-door transit reliability and on-time performance is in the high 90s. So how the railroads manufacture this dock to dock or door to door if it's intermodal product has got to be focused on how to raise that level of reliability of the transit experience much closer to truck. The second element of that is to become much more proactive about how they deliver or how they respond to and proactively notify and resolve in-transit problems that do occur. They occur in the trucking community as well as in the railroad community, but the trucking community has a much more proactive stance about how they handle those exceptions and resolve them. And the last one is embracing true customer centricity, shifting the mindset from an internal focus to an external focus and asking at every customer moment of truth, at every step in the process, is this designed to meet the customer's needs? And there's lots of examples that are even outside of the transit experience in terms of interacting with railroads that can, where the railroads can make some substantial improvements in how they interact with and design the process in terms of ease of doing business with customers. So those were the three big themes that came out of the research in terms of what railroads need to do in order to hold share, regain share, and prevent a continued slide in market share with the flexible freight. I want to spend a little time on a few other things that kind of came out of these interviews, some of which surprised even as we held the conversations. One was around digital freight platforms and what those are going to mean or currently mean to the rail industry in terms of market share. And pretty much the shippers we spoke with spoke very openly about the fact that they were trying these digital freight platforms. There's a little bit of FOMO, like fear of missing out. We need to make sure we're at least experimenting with these a little bit in case it turns out there's something really there and we don't want to be left behind. But it is primarily for a full truckload kind of product. There is not yet any sort of element that's emerging that would tell us that the digital freight platform sector is going to, usurp or attempt to, or will create any sort of pressure in the short term for shippers to move to even faster away from rail. On the flip side of that, we would say that it's a trend, it's a growing trend. It doesn't seem to be a fad. And as these digital freight platforms get more and more effective at meeting customer needs in this kind of a framework, that it could accelerate and exacerbate the distance between a rail product and a truck product, which could again influence more share shift. And the other issue is whether or not the railroads themselves would put themselves into a situation where they could offer customers a much more digitally driven product offering, which would, again, possibly close that gap with where the truck market seems to be heading. The second is ESG, and the railroads talk a lot about ESG. It is a true statement that the more freight we put on the railroads, the better off we are as a society. It lowers carbon emissions, it removes congestion off the highways, it lowers the amount of investment we have to make in that highway infrastructure. There's a lot of good that comes from the railroads being growing, thriving aspect of our freight economy. But if you talk directly to shippers, at least at this point, and this may change, and it may change very fast, especially as we see regulations kind of developing and different kinds of governmental incentives that may drive behavior. But shippers are looking for performance. They're looking for the ability to deliver what they are required to deliver to their corporations in order for that corporation to fulfill its mission to its customers. And so they will decide based on price and performance where they will put that freight in order to accomplish that supply chain mission. And while anything they can justify putting on the rail is a good guy because it helps their carbon footprint, putting things onto the rail simply because of the carbon footprint is not yet a high decision factor within these shippers. So the railroads really can't rely on ESG to be the thing that drives freight to those networks. there's got to be an improvement in how they serve that new supply chain, how they improve the transit experience, and how they embrace customer centricity in everything that they do. 3PLs and 4PLs are not sold on rail, and they are becoming more and more influential with shippers. So many of the shippers we spoke with have outsourced truckload kinds of operations to 3PLs and 4PLs. And the 3PLs, but they have kept their rail expertise in-house. It is quite clear that the expertise and the knowledge that you need to work with a railroad is somewhat specialized, and therefore 3PLs don't find that to be a terribly fungible asset, and it's a niche service offering. Whereas in the truckload market, the customers, there's a wide variety of customers, and when you know how to run a truck, you know how to run a truck. It's not so clear that the rail truck management experience is that transferable. And so what we found was most of the 3PLs are somewhat indifferent or do not offer the rail product offering within their portfolio. 36% of the 3PLs that we spoke with and the shippers that we spoke with did articulate that when rail offers advantages, or if the customer is very focused on the fact that they want the rail portfolio taken care of, it is an offering that is provided in some cases. But a cautionary note for the rails is, unless we make railroad management of railroad freight an easier, more fungible aspect in terms of the ability for these 3PLs and 4PLs to do business, it will not be something that the 3PLs and the 4PLs will be very proactively selling to their customers. And that's another area where we see the potential for share to bleed out and to more freight to end up in the trucks just out of the convenience and the lean that you might get out of a third-party provider. So the last point is that this flexible freight requires the entire ecosystem to behave in ways that have not traditionally been the way that the industry has moved. So shippers continuing to make a commitment to infrastructure, location, rolling stock, having the in-house expertise to work with railroads, and to continue to make sure that their TMS systems and technology systems will handle the rail side of things. I would also add here that shipper behavior is a big factor in terms of how well the railroads operate. And it would be very difficult for an individual shipper or group of shippers and industry within that community in a trucking company to have a very large negative impact on the other shippers in that network. And trucking companies are fairly focused on making sure that that doesn't happen. But in a rail network, there are things that can happen where a shipper's behavior in terms of how they manage the equipment, manage the interface, manage the volume surges into the railroad can actually have quite a bit of an effect on how that railroad can operate. Channel partner commitments around assets, technology, customer service, contract terms, flexibility, and how they approach the sales process. In many cases, the railroads are not always direct to the shipper consumer, and those channel partners have to have alignment with their incentives to act in the best interest of that overall network and the railroad network itself, in order to maximize the ability for the railroad to perform. And then lastly, this idea of multi-railroad commitments and the railroads becoming much more tightly integrated with their service offerings and being able to produce reliable ETAs, even in an interline service kind of a situation, and providing a proactive and consistent customer experience, so that customers aren't really forced then to put the level of expertise and energy and effort in when there's a problem of trying to decipher it themselves and find the right person at which railroad in order to try to get some sort of resolution. So the story is not all bleak. We think there is absolutely the opportunity for the railroads to move into a growth environment in the coming years. We think that PSR has done a great deal of good in terms of really getting the railroads to streamline, getting the railroads to eliminate inefficiencies and unnecessary intermediate switching, and becoming much more focused on asset velocity, which ultimately in the end is good for everybody. But it can only go so far. I don't think any of us believe that we're on a journey to a 20% OR, and a 20% OR with one car on your railroad system is not a recipe for success. So we are going to reach the limits of the PSR cost equation. And at that point, the question has to become, okay, how do we take this capacity dividend that has been generated through the PSR initiatives and turn that into growth? What is it going to take in order to bring the customers' confidence and the customers' ability and willingness to grow freight with the railroad back? And we think it's three things. We think it's integrating and understanding that new supply chain. We think it's really truly solving the transit experience and making a much more reliable service product out of in the rail networks, both single line and interline. And lastly, it's becoming truly customer centric in the way that railroads approach their customers at every moment of truth that customer has in the journey. Investors have a role here in terms of really recognizing and rewarding railroads who are doing the things that are going to be required to initiate and ignite that growth for the future. Shippers continuing to educate the railroads on what these total cost choice models are encompassing, and how the railroad's going to need to change in order to continue to be a viable and important aspect of their freight portfolio, and also understanding shippers' impact on the network itself, and how shipper behavior has got to be also included in the equation in terms of keeping the railroads fluid and capable of operating at these higher levels of reliability. We think that the future will be bright, and that the railroads have a tremendous opportunity in front of them to both help grow their portfolio, help society and all of us creating and maintaining one of the most premier freight network in the world, and continuing to grow and take share back off the highway, and maybe free up a few minutes for all of us as we commute here and there in our daily lives. So that's my presentation. I really look forward to having the conversation as we move into the Q&A, and I appreciate your time.